Still digesting Noche Buena and Christmas ham, but markets are back in action today and here to take stock of what is driving global trade and the local economy on these final trading days of 2026. We have with us Matt Erece, economist at Oikonomia Advisory and Research Incorporated. Good morning, Matt. Welcome to the program.
Good morning and Merry Christmas as well to everyone.
Merry Christmas and thanks for joining us. I'm sure you're
Yes,
still
thanks for
recovering from the holidays as all of us. And there's a lot to take stock of here because we have so many things to be talking about before the year ends. Trading never stops. Let's kick off with some global issues. No, we had quite a rough year when it comes to global trade, tariffs, all of that. But why is it that whenever we look at particularly US stocks, no, they are still up? The economy there seems very strong despite the fact that Trump has slapped tariffs on everyone. Nobody's really happy. Can you please explain this in a nutshell, in simple terms? How is the US economy still strong? How are US markets still strong?
Okay, so despite all the political issues, despite all of that tug of war on tariff rates, we can see a lot of bullish sentiment when it comes to tech stocks, especially during this AI age or AI revolution. Because most tech stocks, especially the big ones, Nvidia and all of them, comprise most of Nasdaq. And we can see that share prices are still up, earnings are still beating expectations. Therefore, global markets, especially Nasdaq and major stock indices, are still up despite all of these political headwinds.
Okay, so a lot of tech stocks still cushioning the trade issue blow. We have some analysts saying that the pain of the tariffs that Trump put in place this past year will be felt next year. Do you agree with that pronouncement? And if so, what's going to be the outlook for the global economy in 2026?
Yep. I also heard a lot of analysts expecting that inflation in the US will go up because of the additional taxes imposed on goods. But we can still see some of the firms absorbing some of that increased costs when it comes to tariffs, as well as some relaxing or postponements in tariffs. But then the lagged effects would probably start next year, especially once these costs are passed on to final consumers.
What about the Philippines? For a long time, we've been, let's say, isolated or cushioned from all of these trade issues. Are we going to start feeling the pinch next year?
I think the sentiment that we are isolated from all these trade tensions is because most of our economy is driven by domestic activities based on household spending, government spending, and all the other, I guess, local activities that we have here. But when it comes to our trade sector, that will start to become something to worry about. But then there's another factor that we must also factor in when it comes to our trade performance, and that would be exchange rates. Despite all of the, I guess, gloomy sentiments that the peso is weakening against the dollar, that may even be helpful in improving our export sector. That could help us maybe steer during this very rough trade environment.
Okay, so the weak peso is actually helping us when it comes to export. But let's talk about what you mentioned, the domestic consumption and the domestic economy. The Bangko Sentral has just mentioned that it sees us rebounding from the lowest that we've seen, I mean, in several, semesters, several years, the 4% print in the third quarter. We will be rebounding by 2026 later on pa. And then targets from 2027. How will this affect market sentiment? And can you comment on the BSP's pronouncement?
I'd also like to commend the BSP because all of their consistency when it comes to monetary policy, when it comes to propping up the local economy, has been all good moves. However, we can still see that the looming or the strong corruption scandal is still the heaviest weight that is pulling down the Philippine economy, especially during the last quarter where we see just 4%. That is mainly driven by the huge decline when it comes to government spending. And despite all of the easing moves by the BSP, which started late last year up to now, that that could only do so much. We still have to see some reforms or at least some positive moves when it comes to fiscal policy in order to fully realize that expected rebound in 2026.
Let's talk about the easing of the Banco Central. You mentioned that this isn't enough, and they're going to be, I mean, a lot of analysts are expecting another 200 basis points for the triple R, so from 5% to 3%. Some are saying we don't need that, we can't absorb this extra liquidity. Is there still a point for us to be slashing triple R rates, to be slashing interest rates? We've already gone down to 4.5%. Do we still need it lower and more eased?
We still have a lot of headroom when it comes to monetary policy easing. And that is mainly driven by lower than expected inflation, even lower than our targets of 2 to 4%. I expect inflation for the year to be around 1.7 to 1.8, which gives us a lot of headroom when it comes to monetary policy. But then that could only do so much. Investments would probably increase, the local stocks would benefit from these moves, but then the overall GDP growth will still need a lot of help, especially from the fiscal sector.
Can you tell us what help we need? So there's already some transparency hopefully happening in this corruption scandal, diba? You also have the budget. We're waiting to see whether the budget will be approved or reenacted in the first week of 2026. Where are the risks tilted to when it comes to our growth? Upside, downside, and what are the catalysts we need?
The basics of fiscal policy mainly stems from either cutting or controlling taxes and also in controlling spending. When it comes to taxes, we can see a lot of sectors wishing for some relaxation on taxes, some amnesties, and even some reviews on the VAT, which are all positive moves that could be detrimental when it comes to the tax base, but on the overall economy, if that extra income, that extra disposable income could be used to do a lot more activities, that would become more helpful. Then when it comes to spending, that is where we should see a lot more improvement or a lot more deliberate action from, especially when it comes to the budget for next year. If we can see that the budget is positive towards more spending, especially on productive sectors, and hopefully that could be used the right way or in its intended way. That would be the positive catalyst that is needed to see better growth for 2026.
Matt, looking at the economic numbers, do you see or where do you see that investors are worried about this corruption issue? Are they really, or are they more looking at the domestic consumption story, the strength of the economy next year? Are they really, is this such a big concern for foreign investors, you think?
First of all, it definitely is a factor, but it isn't a major one.
Okay.
Number one, it's because the business fundamentals are still strong, companies are still earning well, and they post a lot good dividends this year, which are all helpful when it comes to valuation and hype or sentiment when it comes to the local stock market. And apart from that, when it comes to GDP growth, investment isn't the major driver. It's still domestic consumption and also government spending. So for household spending, we can see probably a recovery, especially because of the holiday season, which can help in making the economy improve or at least have a better numbers. But government spending would be the controlling factor, which hopefully improves when it comes next year.
And finally, favorite sectors, shining spots in the economy for 2026?
Okay. I think the financial sector would be the one that would receive a lot of support from the central bank, especially because we can see that GDP growth is faltering, but we need more budget or at least relaxing the monetary system in order to fuel more activities for next year. So we can see a lot more activities or lending activities from the financial sector.
All right, so just in time, as we reported that the banking sector remains strong. Thank you so much for those insights, Matt Erece, economist at Oikonomia Advisory and Research.